Okay, I'm going to go through the Terry Company. You have this, both the solution and the problem on Moodle. I'm just going to walk through how you do it just for some practice. So remember that you need the name of the company, so Terry Company, statement of cash flows or cash flow statement, and it has to be for the year ending December 31st, 2016 in this case. I'm not really sure why I put 2013. But anyway, okay, so we have the three sections: operating, investing, and financing. I generally start with the operating. I don't put all three headings down and skip around, but what I do is put the format for the cash flow from operating section, okay? And so before I put words or numbers down, I put the words. You're going to start with net income, add back depreciation, add or subtract gains and losses. So we add losses, subtract gains. I'll talk about why in a second. And then we adjust for changes in current assets. Current assets go the opposite way. Current liabilities go the same way. So those are our formats. Start with net income, add back depreciation and amortization, adjust for gains and losses, adjust for current assets and current liabilities. Okay? All right. So if I have the income statement, I'm going to start there. If I don't have the income statement, I need to look elsewhere. So actually, before I do all that stuff, I want to change column. So I want to go to my balance sheet, and I want to identify what is the change in all these balance sheet accounts, because eventually everything goes through cash. Okay, so I'm going to write this change. I don't necessarily want to deal with typing them there, so I went over here and typed them. So here's my difference column. Please don't do it exactly like I do. Write them over here. That's why you have them. Put them over here. Okay, so I just put them over here because I had my Excel thing. The totals are really not relevant. I just total them up to make sure I haven't hit a wrong number. In the end, as we go through these, I'm going to delete them over here. I would draw a line through them if I had them over here, just to make sure I've got them all taken into account. The next thing I do, notice that retained earnings changes by $18,000, but I really want the retained earnings statement. So I'm going to go up here, and someplace, again, I would put it down here on your paper, not where I do it. I just put it in here because of the answer. Okay, I do beginning retained earnings, and different problems have different years, so just take a second to pay attention to which one is beginning of the year and which one is end of the year, because some companies or some homework will put 2015 over here and 2016 over there, and that's just reading the problem. That's nothing I can really help you with. So this is the beginning of the year, 2015. So I started with $79,000. I add net income, I subtract dividends, and I get ending retained earnings of $97,000. So right now I should have $79,000 and $97,000 and two lines blank, okay? If I'm given the income statement, net income, I plug it in, so I have $35,000 there, and that means I have $17,000 of dividends declared. Please note that in other problems, declared is not paid, so I'd look up here for a dividends payable, and I don't have a dividends payable, so they must be all cash. So I'm backing into my dividends, okay? All right, so I start off with net income. So my net income is $35,000. I get straight from the income statement. Okay, so I'm going to just highlight these as I go down them so I have them taken care of. Okay, I have my $35,000, that's done. Okay, so notice I also am going to cross that off. So I've sort of got some of my change in retained earnings done, and I'm going to delete it when I have it completely taken care of. I add back depreciation and amortization. The best place to look is in your income statement. Okay, and so I look here and I do not have amortization, but I do have depreciation. It is a non-cash expense, so I need to add that back. So I have my $11,000. Okay. If you don't have any sales of property, that will be the change in your accumulated depreciation. So I look down here and I see it went from 61 to 72. That increased by 11. It's the same as depreciation expense, so I must not have had any sales. So I've honestly got that taken care of. It's already in here. All right, note that you cannot always do that, because if I have accumulated depreciation, think of a fixed asset sale. I get the fixed asset off my books, I get accumulated depreciation off my books. Okay, so the change in it can be different. Usually what I do is I draw a T account of accumulated depreciation, and kind of like retained earnings, put the beginning of the amount and the end of the amount in, and then I look for my depreciation expense, and then I can back into my asset sales that way. Okay, but anyway, I have no asset sales, so my change in accumulated depreciation must be my depreciation expense. Then I'm going to look for gains and losses, and again, those are in the income statement because we learned about the income statement last chapter. So I have a loss on sale of investments, okay? What I need to do with losses, the same as depreciation. Depreciation, I'm adding it back because it's a non-cash expense. Losses, I'm adding it back in because sales of investments, sales of property, plant, and equipment, sales of fixed assets don't go in the operating section, they go in the investing section. So I'm removing them from the operating section. So I have 2,000 there. Okay? I'm actually going to put that in a little different color, and you'll see why in just a second. Okay. Then I'm going to go through my, I have no gains. If I had a gain, I'd subtract it out. I need to remove them because gains and losses go in a different section. Okay? Then I go through my current assets, and I see that accounts receivable decreased. If accounts receivable decreased, I add it back. We'll talk about why that's in class, but so I'm going to delete that in there because I've got that done. Okay. Inventory increased, so I subtract it. I've got that done. Whoops, I want to do these yellow. So now I've taken care of my inventory. Okay. PPA, prepaid advertising. Prepaid advertising is a current asset, and it went from 9,000 to 12,000, so it increased, so I subtract it. And long-term investments is not a current asset. Plant assets is not a current asset, so I'm done with my current assets. Okay, so I'm actually going to delete that one. All right. Now I go down to my current liabilities. Current liabilities go the same way, so I want to make sure I've got it figured out. So current liabilities increased. So if current liabilities increased, they go the same way. And so that one's done. My next one is wages payable. Wages payable also increased, so I add it. And the last one is income taxes payable, and income taxes payable decreased, so I subtract it. Okay, so once I'm done with all my current assets and current liabilities, I'm done with that section of the cash flow statement. There are only two exceptions to the current assets and current liabilities that don't go up there. It's cash doesn't go there, and if I had a dividends payable, it doesn't go there. I would have to adjust this 17,000 by that dividends payable. All right, so now I've adjusted for that, and I have crossed them off as I went along. And so notice this long-term investments, this $2,000, I'm going to put right down there so I don't forget it. Okay, so now I add up all these, and they add up to 38,000. So I've got that done. Okay, so I'm done with my operating section and my cash flow statement. The reason that let me talk about the liabilities first, okay? We all know that my income statement is on the accrual basis of accounting. And so if accounts payable goes up, that means I've got more bills that I haven't paid. So if you think about this, look at accounts payable here. During 2016, I paid off all these bills. Okay, so those would not be in these expenses up here because they were the expense in 2015, but I paid them in 2016. Okay, so I would reduce cash because they're paid off. However, these are expense in 2016, but not yet paid. Okay, so notice in accounts payable that cash increases because I have more unpaid bills than I had last year. Another way you can think about this, and probably an easier way to picture it, is as my bills increase on my desk, my cash balance is also pretty high. But the second I start paying off my bills and reducing my bills on my desk, cash starts going down. So all liabilities go the same way as cash, okay? All current assets go the opposite way of cash. So think about it. The more inventory I buy, the more cash is going down because I'm having to pay for that inventory with cash, okay? And it's just a timing difference of when the inventory gets on my books and paid, but I also know that basically the more inventory I get, cash goes down. So up goes inventory, down goes cash, and that's why current assets go the opposite way. And we'll talk a little bit more about that in class, but I want to make this video short. Okay, so notice what I have left, and I've talked about that you look at the current assets section and the current liabilities section for your operating section. We look at our long-term assets section for the investing section. Okay, so here I have two long-term investments, and you notice that long-term investments went down by $10,000. So I must have sold it. So let's think about your journal entry. And I don't really like using this mouse, but I guess I'm going to have to. Okay. So if you think about your investments, I sold them. So I credited my investments account to get them off my books for $10,000. Okay. I sold them for cash, so I debited cash. And I'm trying to back into this amount because that goes on the cash flow statement. But notice I had a loss on my sale of investments, and losses are debits, so you guys need to already know that. So losses are debits of $2,000. Okay, so notice I can back into the cash of $8,000. If this had been a gain of $2,000, my cash would have been $12,000. So generally what I do, I'm going to clear that, but I'm trying to look for this journal entry. Okay, but generally what I do is let me get rid of that there. I notice I've taken or added back my loss on sale here to take it out here. Add back my loss on sale here to take it out here. So I sold my investments. They went down by $10,000. So remember, assets go the opposite way of cash. So my cash must have gone up by $10,000 minus $2,000. Add it back here, subtract it out there. Or better way yet is to back into the journal entry. So that's where I have my $8,000. And so I'm going to make this one orange because look, 8 plus 2 takes care of that 10. Done with that. Okay. Next one, my plant assets increased by $48,000 from 130 to 178. So if they increased, I must have bought more. Be careful because if I sold some, you wouldn't know. You'd have to have some additional information down here that you sold some and purchased some. So if I sold some and purchased some, I would need to know that because they go on two separate lines. But since there's no information given that I sold any, and also my accumulated depreciation difference agrees with my depreciation expense, so I can say with some confidence that I didn't sell any. So notice I've taken care of that, $48,000 just directly. Okay, so I'm done with that. So the only asset I have left that hasn't gone in my cash flow statement is $5,000 cash. Okay, so I'm done with this one also. Then I go to my financing section, and in my financing section I look at my long-term debt and owner's equity. I have no long-term debt, but I do have owner's equity. Notice that if I had additional paid-in capital, I would need to add it to the common stock here because when I sell stock, I debit cash and credit common stock and credit additional paid-in capital. I'm always looking for the cash in the journal entry, so sometimes if you make the original journal entry so you can see the cash. All right, but my common stock changed by $14,000 and went from 125 to 139, so I must have sold common stock by that $14,000. So again, liabilities and owner's equity go the same way, but I don't really pay attention to that. I just see, okay, well, common stock increased, so I must have sold it and got cash. Okay, so cash came in the door for 14, and I've accounted for that change. Okay, so the only thing left is I have retained earnings here, but remember, I really want to know the difference is 18, but that difference of 18, I've already put net income in there. So of my $18,000 change, I've adjusted for $35,000. So I need the rest of it, which is a negative 17,000. So 35 minus 17 is the 8,000. So I usually just don't get that. I usually do this statement up here because I want this 17,000 there. And so if you notice, I want that 18,000 back down there. I could do this for the retained earnings statement. Let's do green. Those two took into account my change in retained earnings. Okay, so now I add those and I get my 3,000 there. All right, I add these up. 38,000 minus 40,000 minus 3,000, I get a negative 5,000, okay? That is what I compare to this. That's one nice thing about a cash flow statement is you have a check figure. They're not easy, but you have a check figure, okay? So then I put my beginning of year cash. You can't stop at the $5,000. A lot of people just want to stop at the $5,000, and if you do that, you lose points. But I have cash at the beginning of the year, this 13,000, and negative 5 plus 13 is 8, which should agree to cash at the end of the year. And you are done with your cash flow statement.